All right, so the first thing that I wanted to discuss this evening was just basically just a couple of talking points that I wanted to go over with everybody as we get into our analysis for the week. So first thing I wanted to say was basically in this, we're going to keep it kind of basic this evening and kind of head back to some basic things to make sure that one, we're understanding and become absolutely great and solid at the basics. So that's going to be the basis of our discussion this evening. Just talking about just basic things to look for and look at in the market, and some of the building blocks of this whole trading thing, especially when it comes to forex. So the first thing that I was going to say was that with this whole thing, when we talk about strategies, so one of the reasons for learning and understanding, not just learning, right, but understanding different strategies is very simple. It's because that there's no one strategy. There's no secret strategy, no secret indicator, no cheat code, no anything that's going to apply and make you consistently profitable in the market 100%. Not one strategy, not one thing, not one indicator, anything. The reason being is because the market is ever changing. The market changes. It changes from year to year, from month to month, from day to day, from news release to news release. The market changes. And the good thing about it, about learning different strategies, is that you can have different strategies to utilize in different market environments. That's a really, really key thing, because no one strategy can apply to the market all the time. That's why people end up losing with, these so-called strategies and get frustrated and say, oh, this strategy doesn't work. Doesn't mean that a strategy doesn't work. It just means that that strategy that you're using isn't working in that market environment, or for that instrument for that matter. So a good thing to do or to note is to, one, understand that because you lose a trade or something, or you utilize a strategy that fails you, doesn't mean that that strategy doesn't work. Again, it just means that it didn't work that day. It didn't work for that particular market. And it didn't work for this particular environment or what have you. So what we do is we learn and we put in our toolboxes and our toolkits different strategies that can be utilized in different market environments. I just really, really wanted to emphasize that point, that your strategy is not necessarily a bad strategy. It just may be not the strategy to utilize for that market. So that was the first point I wanted to make. Multiple strategies. It's good. Learn them. Learn all the strategies that you can. Understand them. And then start to figure out when to utilize them. When to utilize, which strategy. Because, there's strategies for everything, for every environment, for every market type of trading scenario, for every instrument, there's a strategy. And then, again, the big thing, though, is making sure that the strategies that you're utilizing, that you truly understand them. You've tested them, you've vetted them, and you understand when they work best. Because there's going to be times in the market you're going to have to pivot, basically switch strategies real quick, or what have you. So one of the things, so in looking at last week, right, one of the things that ended up happening was, so when we first started this, LC and I, we started this whole thing together, right? And one of the things that we kind of stayed away from for a while, for a long time, was trading the news. And the reason being is because we really didn't understand it. So when we talk about fundamentals, understand a little bit of it, but not much, or how it really affected the market or what have you. So we really didn't trade it. Well, actually we traded it, but we were trading the news and didn't know we were trading the news. So we got lucky in the market sometimes, and we got really unlucky in the market sometimes. So, but because we didn't know why we were losing the trades. We didn't know why we was winning the trades. We were just, going up and down. We couldn't figure out why. So anyway, it wasn't no particular strategy or anything. It was just not understanding the market as a whole. So we really, that was a time period where we weren't really digging into fundamentals. But we have since then, again, experienced as well. all of these concepts build on each other. So as you gain experience, as you gain knowledge, experience and different skill sets and different strategies throughout this journey, you start to understand things more and more, or what have you, because we're going to go back to looking at volume today, because I understand some things about volume that I didn't understand a few months ago as good as I understand them now. So I'll show it to you all so that you now can start to understand it as well and how to best utilize it. But going back to fundamentals. So now we've gotten to a point where we trade the news, and we trade it pretty efficiently. When I say efficiently, I mean spot on almost every time. So something happened in the market last week where, we were both scratching our heads. It was like, that didn't make sense, right? We had the right strategy, the right analysis, everything, right entries, all that good stuff. But the market moved against what we analyzed and what we thought was going to happen based off of the news and everything that we were seeing, right? We've done this quite a few times over the last few weeks, and every time we've been spot on. So when the market, so the news came out, and it came out at like 2:00, right? The market reaction was instant. The market jumped up, boom, off the news. Then and nobody could understand exactly why, because based off the news, based off of everything that was happening, and I'll explain what it was. So it was the Fed. So the Fed had a meeting last week. They were in their 2-day meeting where they were going to make the decision to raise the interest rates, right, in order to quell inflation. So basically, everybody knew, it was almost pretty much a known fact that the Fed was going to make the decision to raise the interest rate 75 basis points, right? We still got to do something with inflation. And so that was the thought process. And every single time, every single rate hike, and I think it's been 4 so far, the market reacted in a way where the market sold off. So all of the markets, S&P, US 100, US 30. So the SPY for those that don't, the S&P. So you had the 500, you had the Dow Jones, and you had the other one that typically when the Fed raised the interest rate 75 basis points, everybody started selling off their market shares. And basically what they ended up doing was, for the dollar, that strengthened the dollar. So as they're selling off their shares, they're buying the dollar. So these are all your fundamentals. And understanding this stuff is really important to the trading, understanding why the market is moving. That's why fundamentals are important, because it tells you why the market is doing what it's doing. Why is price moving up instead of down? Why is price moving down instead of up? Why is price moving in a range, right? There's a reason for that. So these big moves, the big interest rate hikes, caused the Euro USD to is what has caused the USD to continuously be in a downtrend for a majority of this year, right? Because the dollar was strengthening, again, weakening the euro and the GBP and all other currencies against it. And like I said, a big sell-off in market shares, right? So this day, though, so last week, when the announcement came that they were raising the interest rate 75 basis point, the market had the opposite reaction this time. And that had us scratching our heads, had the commentators scratching their heads. Nobody could figure out why. And the reason the market reacted that way is because, so typically after the decision comes out at 2:00, Jerome Powell goes and does a news conference at 2:30. So my big thing is that there's going to be 2 opportunities for the market to have a reaction. And what happened with the 2:00 news was that the financial institutions, they've been looking for a reason to sell off the dollar and to push everybody into buying shares, right? They've been looking for a reason for that to happen. And the thought process was that, all right, he's going to raise the interest rates, and then during the 2:30 conference, he's going to give an indication that they're going to start slowing down the raising of the interest rates. Like at some point, he's going to say it, right? He's going to say it this afternoon. It's coming, right? That was the belief of the financial institutions, or at least what they were hoping was going to happen, which is why they reacted the way that they did and sold off the dollar. It was huge, big move. Sold the dollar off. It was crazy. And I lost some money on that one. But be that as it may, though, so that's what they were hoping at 2:30, that he came and gave some indication that they were going to start slowing down the raising of interest rates, that at some point next year, maybe in second quarter, they were going to go to 50 basis points instead of 75, right? Well, guess what? Come 2:30, Jerome Powell didn't do that. Jerome Powell came in and he actually said that we're actually, basically going to do something opposite of slow down. We see no indication right now that there's any reason to go below 75 basis points in raising the interest rates, that inflation is still out of control. And I will tell you, like right around 235, 240, something like that, the market went crazy. That initial move that happened from the 2 o'clock 75 basis point hike, that initial move where they sold off the dollar, absolutely reversed in minutes. It reversed and absolutely killed all of the stocks, killed everything else. The dollar started getting bought again. Euro went down, GBP went down, all of that stuff, right? And so anyway, with that being said, my point being to all of this is that the initial news and trading fundamentals ended up being a losing trade, not because the analysis was bad, not because anything that we did was wrong, not because our timing was off or nothing like that. It was because of manipulation. And this is what happens in the market all too often. Again, we have to understand these things so that we can trade effectively and efficiently, right? You want to be on the right side of the market. So understanding fundamentals is very important. You got your technicals, you got your fundamentals. So anyway, when this happened, I was looking at it and I watched it and I said, look, I guarantee, not necessarily guarantee, but I had a good feeling that what the institutions wanted to happen was not going to happen, and that the market was going to have a different reaction come 2:30, because I've seen it happen. I've seen it play out where there was a tale of two tapes, a tale of two markets, right? The market does one thing at one moment and does the exact opposite the next moment. And I had a feeling that was going to happen. So because I had a feeling that was going to happen, I just waited for it. And when it happened, I was already in the market on the right side and was able to catch the huge drop that happened right around 235, 240 on Wednesday, I believe it was. We had that big drop. And it was absolutely crazy because the market went absolutely crazy. So now what you're going to start to see in the market with the markets and the dollar, because he doubled down and he made it very clear that they're not looking to slow down on raising the interest rates anytime soon, is you might start to see a little bit back and forth, because there's a big campaign now. And that's what you probably saw, in Thursday and Friday, where the market's been kind of crazy up and down because there's a huge campaign to basically try to loosen the strength of the dollar. And the reason for that is because obviously when it comes to inflation is good for big business, not good for the consumer. So the problem with inflation is that prices are way too high. Gas prices, the price of goods and services, all of that stuff is too high, but consumers are continuing to pay those high prices. If that does not get in check, so the purpose of raising the interest rates is to entice consumers to slow down their spending. Again, the financial institutions don't like that because that's money out of their pockets. Again, it's all about greed at the end of the day, right? So what you're going to start to see, because he's not looking to slow down the raising of the interest rates because consumers are still spending. Now we're about to go into the holiday season, which isn't going to help the case at all. But again, the financial institutions want people out there spending money. They want to keep their prices and stuff high. So there's a financial war coming in this economy. And again, the elections, the November elections that we're about to have come next week, are going to be based off of the economy or what have you. And again, to lend validation to what we're about to look at as far as technical analysis and everything, I just wanted everybody to understand that these are the reasons for what you're seeing in the market and what you're about to see. So when you're paying attention to the news, just listen for some of these things. You know, again, the financial institutions want the markets. They want people to continue to pay high prices. They want the dollar, when the dollar is strong, right? That means your money is worth more. That means the dollar, with the dollar being so strong, your dollar is worth more. The problem right now is that inflation and prices are so high that it's competing with the dollar. So everything is competing with each other right now. So again, in order to fight that, the Fed is going to continue to raise interest rates to get consumers to stop spending, which hopefully in turn gets businesses to lower their prices. Because if that does not happen, if inflation continues to run high, majority of the people in this country are going to find themselves in the poorhouse, because they're spending all of that saved up money. And this is the reason why prices are so high right now, because a lot of people have saved up money, you know, because the financial institutions have been reporting out on how much money has been kept in savings accounts, how individuals' credit scores are better now because of the pandemic, right? So the financial institutions are taking advantage of that and keeping their prices high. But eventually people are going to spend all of their money because everybody just wants to be out. Everybody wants to be entertained. So it's good for the financial institutions, but not good for us. But us as consumers don't know any better. We really don't know any better. So we're going to continue to spend money because we're going to do what we want to do. But the Fed knows, and economists know, that eventually in 2023, this is really what's going to lead to the recession. That's why this is so important, that we slow down our spending as consumers so that prices can come down and we keep a little bit more money in our pockets, because the struggle right now and what's going on right now with inflation is absolutely going to lead to a recession come next year, 2023. And how bad that recession is going to determine how quickly and how efficiently the Fed can lower inflation. That's going to all be determined by that right there. So that's why all of this is so important. That's why there's a war against the dollar, to keep the dollar weak, because weakness in the dollar means that your dollar isn't worth that much. So again, just wanted to explain all of that to put everything in context for understanding why the market is moving the way it's moving and what's coming. All right, so as I transition, anybody got any questions about that? Anything that I've said so far? All right, everybody still with me?
Yes, sir.
Yes, still here.
All right, cool. All right, make sure I'm sharing the right screen. All right, Euro USD. All right, let's go. All right, so we'll take a look at the 4-hour real quick. And what I'm gonna do here is I'm gonna switch. So I'm gonna switch screens real quick. We're gonna go to the volume. So I want to bring you all back to the volume profile. So the volume profile, we're gonna look at this. We're gonna look at it on the 15-minute. I'm gonna explain some things about this volume profile that's really key to understanding price and movement of price. So, all right, so to get the volume profile, so you go to indicators. And by the way, Rewa, I'm not sure if you're familiar with TradingView, but we'll get you spun up on TradingView. So this is the platform that we utilize to analyze the market. So this is our main platform for analyzing the market.
Do I need to set up an account right now?
Yes.
Or after this call?
Yes.
Okay.
TradingView.com. You can set up a free account. You don't have to do a paid one. You can do a free account and have access to everything that I'm about to show you all.
Okay.
Yeah. And like I said, we're recording the video, so you'll have the video for reference as well. So anything that you feel like, I don't want you to feel like you have to necessarily take notes because you will have the video at your disposal.
Okay, thank you.
Yep. All right, so for the volume profile, so we go into indicators, and basically you can go to, if you go to technicals on the side here, and then just look volume profile, it'll pull up all of the volume profiles. So the one we're going to use for this particular discussion is going to be the session volume, and I'll show you why. All right, so you click on it, you see I got it saved as a favorite. So any of the good indicators and stuff that you want to utilize, make sure you save them as a favorite. So all you have to do is just go to your favorites list and then click on them to put them on your charts. All right, so I'm gonna make this visible so we can get a good look at what we're looking at here. All right, so can y'all see that? Pretty decent.
Yes.
Okay. All right. And then let's do this too. There we go. Even better. Even better. All right. So look, so this big volume profile that you're seeing, this one right here is from last trading session. So we do session profile, and I'll show you why. And you could do a look back period. So if we make this smaller, you can see some of the other sessions, right? All right, so very first thing that probably stands out to you is this red line that sticks out. So for those that don't know what that is, that's the point of control. So what is the point of controls? We're going to get to that. Basically, but what we want to focus on first, though, we're going to big this up real quick. So we want to focus on first is this histogram here. So two things to understand is that these candlesticks are not an indication of volume. So I want to make sure we understand and understand that difference. A lot of times, again, because I had this understanding that a bullish or a bearish candle, a red or a green candle meant that there's a lot of traders and a lot of trades are being happening in that candle. It does not necessarily mean that. What these candles represent, though, is the movement of price. So price is either bullish or it's bearish, or you have something that's kind of in between. Sometimes you might have a doji, right? And when we get into more advanced trading techniques and understanding, I'll show you all some other stuff to understand what these candles actually mean. But for the sake of today's discussion, we're going to stick with the volume profile, session volume. And what I wanted to point out, so again, the candlesticks are not a indication or represent volume. The candlesticks represent price movement and price movement alone. Now, what moves the price, though, can be volume. But the thing that I came to really understand about volume is that it's not the volume that we see that moves the market, right? And we'll get into that a little bit later in a little bit more advanced techniques. But what I want you all to see with this volume profile, that's going to really, really help you out is this is the volume at the different price points for this particular time frame. So the 15-minute chart. So right here, right? So you got blue volume. Blue volume is going to be that's your buy volume at this price point. And the yellow is your sell volume. Now, one of the things that I used to think about volume was that, and it's not necessarily wrong thinking, but I've come to understand it differently though, and I'll explain. So I used to think that if you have buy volume is what's going to cause the price to move upwards, right? So if you got more buy volume in the market, price is going to move up, right? That's a kind of a basic way of thinking, right? Logic. That's logical, right? That if more individuals are buying the euro, that the price of the euro USD is going to go up. That again is not incorrect thinking, but it's not all the way correct thinking. And I say that because what really moves the market, though, is volume on both sides of the market. So for the market to move, you have to have both buyers and sellers. What happens is, though, is that if I have slightly more of the other at any one price point, then the market is going to move in the direction of the higher volume, so to speak, right? So, and I don't want to get too technical here, so I'm gonna keep it basic. So look, the point of control is the point in this volume profile or this entire volume spectrum here that you had the most volume traded. So what I'm getting at is the most important thing about volume is how much is the not necessarily how much buying and selling you had, but how much of both. That's really the key and what's important about volume. And more so important is where is the accumulation of the majority of the volume? Because then you start to understand where your true supply and resistance points are going to be. So supply, right? Supply being the bottom, right? Where the market basically can't go any lower, right? That's your support. So we have support at the bottom, so your floor, right? And we have resistance at the top. These points are created based off of volume. The market is going to react based off of volume. Again, the point of control is the highest price point at which you had trading volume, right? Now, when we look at this one, we take a look and I want to see right on the line, we had 27,373 buy orders at this price point. Almost equal. We had 27,301 sell orders. Equal volume. But this was the point in this price area, right, that you had the most volume traded. That's what makes this support or resistance, because it can act as support or resistance, but I'm gonna show you how to tell the difference, makes it strong. So this right now is a very, very strong support level, right, on the 15-minute chart. And it's just easier to see on the 15-minute chart than when you go to the higher time frame. So that's why I utilize this to illustrate the thought process right now. So what does that mean? That means that your biggest price movements, the movement of price, what makes you and I both money, what makes the institutional traders money is when price moves from this area. The point of control is the area at which you're going to have the biggest price movements. Why is that important? Because again, this is where I have the biggest potential to make the most money. Not only that, though, this point of control, now that we see that the market is in an uptrend, so to speak, right? So if the market was to come back to this point of control, there's so much volume here that it's almost a no-brainer that price is going to get rejected at this price point, right? Almost a no-brainer, because there's so much volume that was traded here that, and that's the difference maker. And when we're looking for, is price going to reject when it gets back here? Well, yeah, if this is the point of control and we got all of this volume still sitting here, because basically what you're going to see happen is there had to be a significant amount of volume in order to push the price this far to begin with. That's number one, right? In order for, and the other thing is that one of the reasons that price is going to reject here as well, which you see you had a big rejection here, is that, remember, the market moved in the direction of the buyers. So it moved in favor of the buyers. And there was only slightly more buy orders than sell orders at this price point. Slightly, right? But what happened, though, is all of those individuals that put in sell orders are now not in profit. They're all now, if they still have their orders open, and there's still quite a few individuals who put sell trades in because they were expecting the market to go down for whatever reason. Those are your retail traders. They were expecting the market to reverse and continue downward, but it didn't. So you had a whole bunch of sell volume here. So these sellers are what you call trapped trapped volume. So you have a lot of trapped volume. So now what's happening is that these sellers, these individuals that put in sell trades that are now in negative balances, right, on their orders, they're in negative balances right now, are hoping to God that the market, that price comes back to this price point so that they can close their orders out. And when that happens, because in order to, all right, so you put a sell in to execute a sell order. In order for you to exit that order, you have to put a buy order in. So that's why when price gets back here, all of those traders are going to be looking to, all those sell traders are going to be looking to close their sell orders. And what happens is it's going to cause a huge rejection, almost like you see this candle right here, but this was due to something else. But what happens is all of those traders are going to close those sell orders with buy orders, and that's what's going to push the market up once again. That's why the market rejects. That's why you have huge moves sometimes when it's already an established support or resistance, because you have traders who have been trapped there for a long time and they're hoping to get at least break even. And they say to themselves, if I can only get back, if price only gets back to break even, I'll never do that again. I'm going to close my order as soon as price gets there. And you see a huge rejection at this support level. Now, simultaneously though, right, you'll see the buyers who are smart, you'll see the smart money, right? They're going to double down. They're going to add to their buy orders. Now, you had some that closed along the way as the market was pushing up, but those that kept their buy orders open that are still in profit, individuals that closed and are looking for price to come back here so that they can reestablish and get in for a buy, they're going to double down on their orders. And again, you can potentially see another big move to the upside if price comes back down to this area. So in relation, right, you have, so we can see that this is an area of support, right, or value area. This area right here, obviously you have all of this volume right here, right? And this, so interestingly enough, so this line right here comes from the point of control from the previous session. So watch this. We move over. We see the point of control right here, right? That's what has created this value area right here, which is why price bounced off of it, right? A perfect example of price rejecting a value area, right? So this point of control was created, again, based off of all of this buy and sell volume that was right here, right? Let's take a look. Let's see what it was. Whoo-wee. That was even more volume than this point of control. So you're looking at a total volume of 64,000 orders, both buy and sell. 64,000 was sitting here. Again, that's why when price came back to it, to this area right here, because it was based off this point of control, it bounced off because you had all of those trap traders that had those sell orders in, right? They closed their orders as soon as price got down there. They probably had it there waiting. They probably had the order waiting, the limit order or something right there waiting to close out that order. And it caused a huge rejection back to the upside. But then what did they do though? They turned around and did it again. Turned around and did the same thing again. And what's going to happen is, again, we come back to this area. We can look for price to do a potential bounce and rejection off. Now, something to note of this volume profile here. I wanted to make sure you all understood this. So when a move is happening, my thing is, because you have what's called breakout traders. So be very careful of being a breakout trader. I would caution a bit against being a breakout trader because most breakouts are fake outs. There's percentages and studies that's shown that most breakouts are fake outs. But what happens is, so we see this area right here and we see how price basically, rejected off, to the downside, right? I mean, we had some volume come in and basically, if we can see, we had a little bit more sell volume than buy volume. So it caused the market to push down. But this is a weak, and you can see it. I don't know if you all can see it right here, but this is a weak high. It's a weak level right here, resistance level that can be broken. But let's not be fooled by a fake out because the market can go and grab liquidity. And we can take a look and see if there's any liquidity. I don't really see much liquidity up top right there, which is why it's showing it as a weak high. So price can really break out. But with breakouts, you got to be very careful because a lot of times breakouts will go grab liquidity and then it'll reverse. It could reverse to the downside. But when we're talking about the volume, though, I wanted to make sure I didn't confuse anybody that as price approaches a potential area of resistance, when you start to see a slowdown in volume, a lot of times that can indicate that traders are just not interested in trading at that price point. So volume will slow down. Now, it doesn't necessarily mean that you're going to get a rejection either, though, right? I wanted to make sure I made that clear. It doesn't necessarily mean you're going to get a rejection. So let's say if this right here was something like this or something like this, a point of control, right? If you have a big area like this, that's if you have a resistance area that is a point of control type of area, then there's a really good chance that price will reject at that area, right? Because there's a lot of volume sitting right there just to push it down, especially if that's where we're coming from. We're in a downtrend or what have you. So again, when you're looking at you're doing your intraday trading and things of that sort, utilizing the volume profile to catch your big movement is probably one of the best trading ideas I can give you right now, is looking at this point of control and looking to get your big moves based off the point of control. Now, before I forget, I don't want to forget this. This point of control is fluid, meaning that as volume comes into the market, this point of control is going to move. This red line is going to move to where the majority of the volume is for that trading session. So basically, this one still holds, right? So this is this is your support now. So basically, this should be your major support level right now, for the market. And then you have your resistance level right there. But again, so we have volume. So you want to look at your highest points of volume. So when you're looking at it, so this is the new volume profile forming for the new trading session starting today, right? So right now, this is where our point of control is in today's market for Euro USD. This is where the point of control is. This is where you got your high volume at the moment for this particular market. Okay, so just wanted to point that out. But again, so something to note, right? So if price comes up here into this area right here, you could potentially look for potential rejection just based off the amount of volume that could be sitting there. So you can look for it to be a rejection point, but it could also be a breakout point as well. So I wouldn't look to necessarily trade it unless we get a little bit more volume possibly, but you can look for rejection signals as well or what have you. I wouldn't bank on it though. Then the other thing to consider as well is, as we look at the higher time frames, is just to consider the direction of the market. So if we're in an uptrend, it's a good idea to probably wait for the breakout to happen, let the market come back to this area and test this area as a support before we get in on a buy trade. That's probably the best way to trade this area right here. Same thing with a rejection. We can come up and possibly look for rejection signals. The only thing I would caution with that is that the market is currently moving into an uptrend, but we're still in the overall downtrend, even though we're getting uptrend signals. Overall, we're still in a downtrend for the most part on the daily. But we are starting to change course though. And the reason I emphasize that is because we haven't yet broken this swing high right now. So overall, we're still a bit bearish. But as we can see, the market has been continuously moving up. So we can look for I would probably look for a breakout, a break of this area right here before we get into a buy trade you know, for something significant, for some significant movement in the way of the bulls. All right, y'all. I think that was pretty much everything that I wanted to discuss with you all today. So what's on you all's minds? What questions y'all got?
I don't have anything at the moment. I think I already pointed out what I was at least watching earlier, and just taking that and adding what you kind of added tonight with the utilizing the volume profile. And you know, now that I look at this volume profile, it kind of reminds me of the stuff on FXS, something like that. I forget what you call it. It kind of looks a little similar as far as the volume portion of it.
Bam. So yes. So you see my screen?
Yeah.
All right. So look, I utilize both, right? So
Mhm.
what I do is, so good point, right, Tony? So to see, because FXSSI, right, it's showing us the actual orders. And you know, my whole discussion about trap traders and stuff. So those are the ones you see that are in losing trades. So when you look at your the profile, the order book, right? So obviously on this side, these are orders that haven't executed yet. But when you look on the orders that are executed, look at all of these sell traders that are in a loss right now. All of that right there in the blue are losing sell trades right now. So basically, like I was saying, most of these people are hoping that price comes back to their area so they can close their trades out. But you're right. And that's why price moves the way that it does, because of the orders that's sitting there. So when we were talking about how to read and utilize the order book, basically the same concept, right? Price is going to gravitate to the volume. And that's what that is. Basically, when you got your stop loss clusters, again, that's liquidity. The volume, these orders and stuff, that's all liquidity in the market. So basically what stop loss clusters and things like that, those are high points of liquidity in the market that can help to move the market. So all things to consider.
Okay.
And I like, so you see how I got my zigzag lines on here? It's been kind of difficult if you see how the zigzag lines been going. If you think about your impulse and your corrective, like that's all just kind of weird looking to me.
Gotcha.
Not like we're used to.
Yeah, not like that. It'll give you some general idea.
Definitely. But yeah, so for FX SSI, I definitely look at the order book so I can just you know, I'm all about confluences, right? So I can verify, you know, where what I'm seeing over here is the same thing that's here. And you know, when I see that, it gives me really good indication. As you can see, obviously we got some volume sitting right here, right? So that shows why the market is currently rejecting at the moment, because we got this volume sitting right here.
I got you.
I have a question.
Yep.
Um, so with these different movements that are going on, do you have money sitting somewhere, or are you constantly watching to know when to put in or take out money?
So the latter, Rewa. So right now, typically what I do is so day trading, right? More scalping at this point. I'm in and out of the market because the market is so volatile. I tend not to hold my trades for too long. So we have a bit of a strategy that we've been utilizing lately to try to capitalize and get more capital out of the market. So what we've done is, so I'll give you an example of what LC and I have been doing. So let's say we decided to take a buy trade right here, right? So what we do is, so we'll put the trade in, and I'll show you. I can illustrate it. Let's do this long position. Yep. All right. So we're gonna take this right here, right? So I'm looking to put a buy trade in right here, right? So boom, put it in right here. All right. So what I'm gonna do is I'm gonna put my stop loss at the swing low. All right. So that's roughly an 11 pip stop loss. Let me see.
Are you doing something on the screen? Because
Oh yeah, I'm sorry. Thanks, Tony. Let me switch screens. Thank you. New share. Boom, right here. All right, can y'all see that?
yes.
Okay.
Yes.
All right. Thanks, Tony. So yeah, so basically, so if I put an order in right here, right? So if I was utilizing this point of control, I would definitely look to put a buy order in, right? So I would target the previous swing low, which puts me at roughly about 11 pips or so. And what I would do is my initial target would be 10 pips. So that's my initial target usually. And so let's do it like that. So we'll just do it like that, just for illustration purposes. So what happens is, so once price moves in my direction, 10 pips. So then what I'm gonna do is I'm gonna take my stop loss. So my stop loss being the risk. So how much I'm willing to risk on this particular trade to let the market come against me before it takes me out of that trade, right? So that's my risk. And then what I'll do is once I lock in 10 pips, the market moves 10 pips in my direction, and I feel like it's going to be a bigger move than 10 pips, I'll move to what's called break even. So I'm going to move my stop loss now to where my entry point was, right? So I move it to my entry point. So now at this point, I'm not risking anything. There's zero risk. I'm in profit now. So if the market moves 10 more pips in my direction, I'm now going to move my stop loss 10 pips in my direction. So now what I just did was I just locked in 10 pips worth of profit. So let's say the market keeps moving in my direction, right? I'm going to move. So the market moves another 10 pips in my direction. So we at 30 pips. What I'm going to do, I'm going to move my stop loss because I may not be watching when the market turns against me. So I'm going to just continue to manually move my stop loss. Now I just locked in 20 pips, right? Profit. No matter what happens now, I'm 20 pips profit in. Okay. So let's say the market decides now to move against me. That's fine. It's cool. I'm out. Once it moves against me, comes back to my stop loss, takes me out. I just came out of the move 20 pips richer. That makes sense. But typically, a typical move though, I target 10 pips or more. I typically target 10 pips. If I can get more, then that's what I'll do. What I just showed you, Rewa, is I'll manually move it to basically minimize my risk and lock in profits as the market continues to move in my direction.
Okay. So I see this as a constant thing, daily.
Yes, yes.
Okay.
But really where you want to be though, so I just do that because the volatility and I can watch it.
Okay.
But where you really want to be though is you want to be able to put an order in, and you typically do that at the higher time frames. So one of the things we did was we were looking at, let's say, the 4-hour chart, right? And let's say this was our target area right here. So we would target this area right here and say, all right, when price gets here, we'll start looking to put in a sell order to basically ride price down back to this area right here. So this now, you now become a swing trader. So you're swing trading when you're doing typically anything from 4 hours and up, because you're looking to hold that trade a bit longer in the hopes of getting more pips. So a move like this could net you, let's say price did come back to this area, rejected off, and you targeted this area right here. So that's basically 174 pip move. But a move like that could take you a couple days. And it just depends on your patience. It just depends on your patience. So if you got the patience to hold for that long, because the market in between time, the market is going to move against you. But if you have a good stop loss and if it's a good move, you can continue to stay in that trade. But I just moved away from that for now because of the volatility in the market. But where we like to be is we like to trade off of the 4-hour chart and hold our trades, until it gets to our target. And typically we'll target roughly 100 pips or so. Tony will tell you, like, we typically try to target 100 pips or more for that big profit, but it just takes a couple of days to do that though.
Okay.
All right. Anything else? Anything from you, LC?
Oh no, I'm good.
Cool. So yeah, I would look for basically, honestly, for Euro USD this week. Honestly, just looking at the RSI and everything, we're more than likely going to be bullish. Just pay attention to what the market is doing. So we want to pay attention to the market and the dollar alike. So we see some indicators that the dollar is continuously gaining strength and the markets are red. It's good for sales for the Euro USD. But if the market is green and the dollar is red, we're looking at basically buys for the Euro USD. And basically, that's pretty much where we're kind of trending right now for Euro USD, is bullish. So it'll be a good one to watch this week to see kind of how the movements look and how big of moves we get, and stuff like that. So, all right, y'all, that's really all I have for everybody today.